The full committee, Ms. Waters, for 5 minutes.
Thank you very much. Mr. Clements, when I served as chairwoman, I investigated the egregious pattern of consumer abuse at Wells Fargo and found that regulators failed to use escalating enforcement actions to correct the bank's bad behavior, even as new and similar abuses emerged. I have legislation that would require the bank regulators to impose limits on bank growth, divestment, and other penalties for noncompliance. That is why I'm pleased to hear that regulators like the CFPB and OCC are beginning to focus on ways to ensure that repeat offenders correct their bad behavior. According to the GAA report, the Federal Reserve and the FDIC have been advising Silicon Valley Bank and Signature Bank about the weaknesses in their risk management and liquidity programs in multiple examinations since 2018. Now, Mr. Clements, from your review, did the banks receive adequate explanation and information from the regulators to know that they had problems and what those problems were and what was needed to fix them?
We certainly saw numerous instances of matters requiring attention, matters requiring board attention, matters requiring immediate attention that laid out issues. And we focused on the liquidity and risk management because that was sort of the proximate causes of the failures. So we didn't go on the various other consumer angles as well. But we have in the past reported that the communication, the clarity on some of the of supervisory letters could be clearer. We issued a report in 2019 on those issues. The agencies have taken steps to address the lack of clarity that they do provide to the banks in their supervisory letters or records of examination.
So, Mr. Clements, if the banks had adequate information on what the problems were and how to fix them for 5 years, what were the reasons they offered for not being able to correct the problems in that time period?
We've, in our past work, have seen a couple of issues. In some instances, the bank will disagree with the finding, and in fact, in the case of Signature Bank, I think there were a few instances where it did not agree with the supervisor's thoughts on where there were problems. In other instances, the bank simply is unable to fix the problems, and we certainly saw in the case of SVB, it agreed with the findings, but they were simply taking them a longer time than needed to get the problems fixed. And obviously, in the interim, the bank failed.
Could you explain a little bit further the excuse that the banks were unable to fix the problem? For example?
In a number of instances, the bank would agree with the problem being cited, but it would simply say it's going to take a while to fix the underlying problem. And in fact, in the case of SVB and the San Francisco Fed, they agreed that it was going to take a while to fix the problem. Unfortunately, the problem got large enough where the bank failed before the problem could get resolved.
Let me just raise a question with you that I really need to understand further. The balance sheet. Does the balance sheet reflect liquidity, and do they have the responsibility to report the securities that they have and the value and whether the value has changed? And someone said to me for the regionals, it's just a footnote. Can you explain that?
A bank of the size of both SVB and Signature, they are required to mark securities that are considered available for sale, mark those to the market value. Any changes to that value is accounted through is an account called accumulated other comprehensive income is where it would be recorded. So it is being recorded. If the securities are held not for sale, then those securities are not marked to the market.
Have there been recommendations about how the balance sheet should reflect the value of those securities?
I'm not aware. In our past work, we have recommended or reported that it's important to have an accurate accounting of the bank's financial condition, to be able to have a good sense of its vulnerabilities.
Thank you very much. I yield back.
The gentlelady's time has expired. The gentleman from Texas, Mr. Sessions, is recognized for 5 minutes.